Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the financial world without needing a finance degree. In this report, we have Cellectar Biosciences. They are a clinical stage biopharmaceutical company, and we will be diving into their financial results for the quarter ending the 30th of September 2025. So buckle up because this one has some interesting twists and turns. And before we dive in, if you like getting straightforward, no nonsense explanations of what these corporate filings actually mean for a company, hit that subscribe button and notification bell. And also join our Discord community linked in the description below for more great discussions. Alright, so we are looking at Cellectar Biosciences' latest quarterly report, a Form 10Q for the period ending the 30th of September 2025. This filing gives us a snapshot of the company's financial health and operations. Let's start by looking at their balance sheet as of the 30th of September 2025. We see their total assets are about $14.6 million. That is down from about $25.5 million at the end of 2024. A big part of this decrease comes from cash and cash equivalents. They had about $12.5 million in cash on hand at the end of September, down from over $23 million at the end of last year. On the other side, their total liabilities are about $5.2 million, down from almost $9.8 million at the end of 2024. Notably, their warrant liability has significantly decreased, which is a key area we will touch on later. Now let's move to the income statement. For the 3 months ended the 30th of September 2025, their net loss was about $4.4 million. Compare that to a net loss of over $14.6 million for the same period in 2024. That is a significant improvement in just 3 months. Looking at the first 9 months of 2025, their net loss was around $16.5 million. A big improvement from nearly $42.2 million lost in the first 9 months of 2024. This improvement is largely due to a massive drop in operating expenses, particularly general and administrative costs, which fell from over $19 million in 2024 to under $9 million in 2025. Research and development expenses also saw a substantial decrease, falling from about $19.9 million to $8.3 million over the same 9-month periods. This reduction in expenses tells a story. It seems the company is scaling back some of its more extensive operations, likely to conserve cash, which is a major theme we will see throughout this report. Looking at the equity section, it's quite complex, as is typical for companies with multiple classes of stock and warrants. As of the 30th of September 2025, they have a substantial accumulated deficit of over $263 million, which is negative stockholders' equity. This indicates that the company has lost more money over its lifetime than it has earned. However, we do see some positive movement in additional paid-in capital, which increased significantly. The net loss for the 9 months ended the 30th of September 2025 was $6.6 million, and for the 3 months ended the 30th of September 2025, it was $4.4 million. These figures are crucial because they represent the actual bleeding of cash. The earlier net loss figures on the statement of operations are before certain adjustments, and these are the ones that impact shareholder equity. Let's dive into the cash flow statement, which tells us where the cash actually came from and where it went. For the 9 months ended the 30th of September 2025, they used about $18.7 million in cash from operations. This is a significant improvement from using about $36.6 million in the same period of 2024. On the financing side, they brought in about $8 million in cash from financing activities in 2025, primarily from the exercise of warrants and issuance of stock. This is a major contrast to bringing in over $61 million in 2024. The net decrease in cash and cash equivalents for the 9 months ended the 30th of September 2025 was over $10.7 million, bringing their total cash down to about $12.5 million. This cash burn is a critical point and directly relates to their ability to continue operating. This brings us to a really important section called Going Concern. The report states that the company has a significant accumulated deficit and has incurred substantial losses. They depend heavily on external funding, and as of the date the report was issued, their unrestricted cash was around $15.6 million. The report warns that without additional funding, they might not be able to operate beyond the 3rd quarter of 2026. This is a flashing red light, folks. Management plans to raise more capital or find a strategic partner, but trees no guarantee this will happen. If these plans fail, they might have to consider selling assets, winding down operations. or even filing for bankruptcy. This uncertainty about their ability to continue operating as a going concern is a serious risk. Looking at the stock and equity details, on the 2nd of July 2025, they completed a public offering that brought in about $6.9 million before expenses. This involved selling common stock units and pre-funded warrants. They also issued warrants to the underwriter. Most of these warrants are classified as equity, which is good for the company's balance sheet. But some of the other warrants, as we will see, are classified as liabilities, which means their value can fluctuate and impact the company's results. An interesting point here is a 1 for -30 reverse stock split that happened in June 2025. Companies often do this to boost their stock price, especially if it has been trading very low, and to meet listing requirements on stock exchanges like Nasdaq. In June 2025, they facilitated the exercise of some outstanding warrants, bringing in about $2.5 million. This is a way to convert potential future inflows into immediate cash. Going back to July 2024, there was a complex warrant exercise involving preferred stock. The company received significant proceeds, but also issued new warrants that are classified as liabilities. This is a key detail because these liability classified warrants are revalued every quarter, and their fluctuating value can create big swings in the company's reported income or loss. Even as of the 30th of September 2025, there are still outstanding warrants from an October 2022 transaction. Many of these are classified as liabilities due to a cash settlement feature, meaning their value is tied to market conditions and affects the company's financial results. Let's look at the outstanding warrants. There are almost 2 million warrants in total that could be exercised. The majority of these are classified as liabilities. This creates a significant potential dilution for existing shareholders and a constant valuation challenge for the company. These liability classified warrants are valued using complex models, and the assumptions used, like stock volatility and risk-free interest rates, can drastically change their reported value. For example, the fair value of the July 2024 warrants was about $600,000 at the end of September 25, down from $1.2 million at the end of 2024. This change directly impacts the company's reported income or loss. Similarly, the October 2022 warrants have a fluctuating fair value. The changes in these valuations are a constant factor, creating non-cash gains or losses that can mask the underlying operational performance. The company also incurs costs for stock-based compensation, which totaled over $1.6 million for the 9 months ended the 30th of September 2025. This is an important expense to watch as it dilutes existing shareholders' ownership. Now, let's talk about earnings per S-share. For the 9 months ended the 30th of September 2025, the diluted net loss per S-share was about $7.82. This is a massive improvement from a diluted loss of over $41 per S-share in 2024. This improvement is driven by the reduced net loss and a significant increase in the weighted average number of shares outstanding as more warrants and preferred stock were exercised or converted. Looking at leases, they have an operating lease for their headquarters. The total undiscounted lease payments are around $548,000, with a present value liability of about $433,000. This is a relatively small commitment compared to their overall financial picture. Cellectar operates with a single reportable segment focused on developing cancer drugs using its PDC platform. All their expenses and revenue, if any, fall under this one umbrella. Digging into their research and development costs, we see a decrease in spending across the board for the 9 months ended the 30th of September 2025 compared to 2024. Clinical project costs dropped significantly, as did manufacturing costs. This aligns with the general trend of cost reduction we observed earlier. General and administrative expenses also saw a substantial decrease, both for the quarter and the 9-month period. This strongly suggests a streamlining of operations and a focus on core R&D activities. The other income expense net line item shows a significant swing. In the first 9 months of 2025, they reported other income of about $793,000, largely due to favorable changes in warrant valuations. This contrasts with a significant expense of over $3.1 million in the same period of 2024, mainly from unfavorable warrant valuation changes. This highlights how crucial warrant valuations are to their reported profitability. This section reinforces the going concern issue. The company is burning cash and needs more funding. They are actively looking for new investors or a strategic deal. Without it, they face serious financial trouble potentially by the third quarter of 2026. This is arguably the biggest risk factor for Cellectar right now. The report also discloses several material weaknesses in their internal controls over financial reporting. These are serious issues related to policies, risk assessment, control activities, and information flow. They even led to restatements of financial statements in the past. While they are working to fix these, it indicates a history of financial reporting challenges, which can concern investors. A major positive development is the feedback from the European Medicines Agency. They've indicated that a submission for conditional marketing approval for iopofosine I-131 for Waldenstrom's macroglobulinemia could be acceptable. Realistically, this means they might be able to sell their drug in Europe as early as 2027 if approved. Adding to that, the US Food and Drug Administration granted breakthrough therapy designation for iopofosine I-131. This is a significant regulatory step that can accelerate the review process. They plan to submit a new drug application to the FDA for accelerated approval of iopofosine I-131 for Waldenstrom's macroglobulinemia based on positive trial data. However, this is contingent on funding and the initiation of a confirmatory trial. This details a more recent event in October 2025 where they induced holders of existing warrants to exercise them, bringing in about $5.8 million. They also issued new warrants in exchange. This is another strategy to raise immediate cash. The report details reductions in both research and development and general and administrative expenses. This is a clear sign of cost cutting. For instance, research and development expenses for the first 9 months of 2025 were about $8.3 million, a substantial drop from $19.9 million in the same period of 2024. This suggests a more focused approach, likely driven by the need to extend their cash runway. So what does all this mean for Cellectar Biosciences? On the one hand, the significant reduction in net loss and operating expenses is a positive sign of fiscal discipline and a move towards efficiency. The progress on iopofosine I-131, with breakthrough therapy designation and positive feedback from the MA, offers genuine hope for future revenue. However, the going concern statement and the material weaknesses in internal controls are substantial red flags. The company's future hinges almost entirely on its ability to secure substantial additional funding or strike a strategic partnership. If they can't manage that, the promising clinical developments might not see the light of day. It is a high-stakes gamble right now. Balance between significant scientific potential and critical financial vulnerabilities. Alright, that is our breakdown of Cellectar Biosciences' latest filing. What is your take on these numbers and what they signal for the company's future? Do you think they can navigate these financial challenges and bring their drugs to market? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives like this. And don't forget, our Discord community is linked in the description for even more in-depth discussions. Thanks for watching, see you next time.